Today we are going to compare purchasing a property in cash versus an operating lease. Often firms and individuals must make a choice between buying or leasing a property. On the other hand, a property can be bought cash or with some kind of financing, for instance, a mortgage. We separate the purchase-lease decision from the financing decision. In this video, the cash purchase is compared with leasing. In a future presentation, the financing decision will be discussed. We start by separating operating from financial leases. These two types of leases are different depending on the way several characteristics are treated in each one of them. Let's start with maintenance and insurance. In the case of the operating lease, maintenance and insurance is the lessor's responsibility, whereas in the financial lease, it's the lessee's responsibility. The second characteristic is the cancellation option. That is, the right that the lessee might cancel the contract at any time. In the case of the operating lease, the lessee has the option to cancel the contract, usually once a year. In the case of the financial lease, we are talking about a long-term contract and there is no cancellation option. The third issue is the purchase option, and by this we mean the possible right that the occupant of the property might buy the property at the end of the contract. In the operating lease, there is not a purchase option. In the financial lease, usually there is a purchase option, although not necessarily so. And finally, the accounting treatment. In the case of the operating lease, the lease payments are deductible for tax purposes. In the financial lease, the accounting treatment depends on whether a purchasing option exists or not. If there is no purchase option for the property at the end, simply the future payments for the lease are accounted for as a liability. Basically, the present value of the future lease payments are accounted for as a liability in the balance sheet, and there is an asset of the same quantity on the other side of the balance sheet. And these amounts decrease as we approach the maturity of the lease. In the case of the purchase, we have a purchase option. Well, the asset is considered as being property of the lessee from the start, and the depreciation applies from the start. So the depreciation is tax deductible. Sometimes financial leases without the purchase option are called operating leases. This is very confusing, and we are going to ignore this possibility. So we are going to clearly separate operating from financial leases. Financial leases are considered an alternative to borrowing, whereas operating leases are not. Financial considerations. When we buy cash, two things happen. On the one hand, we stop paying rent. On the other hand, we make a bet on the future value of the property. Also, there is an opportunity cost of the invested amount. By this we mean that when we buy cash a property, we are putting a lot of money in this property and we expect to have a reasonable return on the property. This return is the discount rate that we apply to evaluate this investment, and this discount rate must be consistent with the risk of the property. Buying will be better than leasing when the present value of the saved rents plus the expected revalorization of the property, both discounted at the opportunity cost of money, that is the discount rate we mentioned before, this total present value is larger than the price of the property. meaning that we have a positive net present value. Let's illustrate with an example. Imagine that we are considering buying a property whose price is $150,000. Initial rent is $25,000 and the rent will grow at a yearly rate of 2%. Also, we assume that the value of the property will grow at a yearly rate of 2%. We have two expenses, insurance and maintenance, of $500 at T0 prices. And we assume that these expenses will grow also at a yearly rate of 2%. We pay a property tax of 1.5% of the value of the property every year. We pay purchasing expenses. When we buy the property at the beginning, we have to pay purchasing expenses equivalent to 7% of the value of the property. And when we sell the property at the end of 5 years, we have to also to pay 7% on the value of the property as selling expenses. Depreciation will be $5,000 yearly, the discount rate 12%, and the corporate tax rate 30%. Let's do the analysis. First, let's look at the cash flow of purchasing the property cash. So here we see the different items. First, the purchase cash flows at the beginning minus 150,000 and the end plus 165,612 with 12 cents. This last value represents the initial value of the property plus 2% cumulative additional value over the years. We have the purchasing and selling expenses at time 0 and time 5. And we have all the other expenses, property taxes, insurance, maintenance. If we add this up, we obtain the before tax cash flow corresponding to purchasing the property. So we have minus 160,500 in year 0, minus 3,315 in year 1, etc. But of course, we now have to add tax considerations. So first, we know that which are the deductible expenses. We also know that depreciation affects taxes, and the other aspect to take into account is the capital gain of selling the property in year 5. So if we add all this up, we obtain the taxable income. This is the income on which we will apply the corporate tax rate. If we apply the corporate tax rate, we obtain these corporate taxes, 3150 in year 0, 1806 in year 1, etc. If we add up these taxes to the cash flow of the purchasing the property before taxes, we'll obtain the purchasing cash flow after taxes. So the cash flow corresponding to purchasing the property taking into account taxes. And that is the result that we obtain at the bottom here in bold. So it will be minus 150,350 in year 0, 1509 in year 1, negative 1569, 18 cents in year 2, etc. But this analysis ignores the rent that we save in case we purchase the property. So let's look at that issue. Well, if we rent the property, we will have to pay these amounts every year: 25,000 in year 1, 25,500 in year 2, etc. Given that this rent is tax deductible, we have some tax savings here. So the net amount that we obtain after taxes, in case we rent, is 17,500 in year 1, 17,850 in year 2, etc. The last step is just to subtract the purchase cash flow after taxes minus the lease cash flow after taxes. And we obtain this cash flow here, minus 157,350 in year 0, plus 15,991 in year 1, etc. This last cash flow actually represents the decision to buy the property cash, accounting for the rent that we save, given that we bought the property and we are not paying rent anymore. So this is the cash flow that results from purchasing the property minus renting the property. So the minus rent converts into a positive cash flow, which is the rent that we save in case we buy. Well, now we are ready to make the decision. we calculate the net present value of this last cash flow. If this net present value is positive, it means that purchasing is better than leasing. And if it is negative, leasing will be better than purchasing. In this case, we discounted at our 12% discount rate, and we obtained a negative net present value of 11,106 with 31 cents. We also calculated the internal rate of return, which is 10.03% in this case, which is less than 12%. Well, given that the internal rate of return is less than the discount rate, and given that the net present value is negative, in this case, we conclude that purchasing cash is a bad decision. It is better to rent. The last thing to take into account here are the intangibles, meaning all these aspects associated with purchasing or leasing the property, which cannot be quantified. For instance, the benefits of purchasing the property. If we occupy our own property, we have more stability, more security. We cannot be expelled by the owner of the property. But we also have costs. If we own the property, we have less flexibility. If we want to move, for instance, probably we'll have to sell the property or rent it to someone else. Also, we have less liquidity because we have most of our money or a big part of our money invested in the property. And we have a low diversification because we have a sizable amount of our resources invested in one asset. The other issue are expectations. Are prices expected to fall or rise? If we expect prices to rise, of course, it will be better to buy, and vice versa. Capital rationing, meaning that is the eventual lack of funds. For instance, if we do not have the cash to buy the property, then of course buying the property cash is not possible. So the only option that we have is leasing. And finally, competitive advantages. Competitive advantages, this pertains mostly companies. We know that companies, in theory, do business in these areas in which they have competitive advantages. When a company distracts a sizable amount of their resources to buy a piece of real estate, actually the company is distracting these resources into a kind of business in which the company does not have a competitive advantage. So in theory, in general, but not always, but in general, it is not a very good idea for companies to invest in real estate, given that they do not have competitive advantages in this type of business. How do we quantify then the impact of these intangibles? Well, intangibles must be accounted for by comparing the net present value that we obtained before with the subjective value of these intangibles. In our case, buying cash will be better if the subjective value of the intangibles is larger than 11,106 with 31. Remember that we obtained a negative net present value of 11,106. Well, if the intangibles for us have a positive value, which is larger than this 11,106, then of course we will decide to buy in spite of having a negative net present value. Now we conclude. First, the net present value of the purchasing decision must be computed by discounting at the opportunity cost the saver rents plus the expected capital gain minus the additional expenses, everything after taxes. And then this total present value is compared with the price of the property at the beginning. And we subtract the price of the property. If the net present value is positive, it is a good decision to buy. If it is negative, we shouldn't buy. But of course, this does not account for the intangibles. If we account for the intangibles, we can even decide to buy when the net present value is negative, as long as the subjective value of the intangibles is larger than this negative net present value. And this is all I wanted to share with you today.